Follow the money, Japan, China, and the U.S. sell-off. Flint West reporting. The U.S. stock market has seen a notable pullback recently, with the S&P 500 dropping from recent highs around 7,600 down toward the low 7,300 area in intraday and closing action. That represents one of the sharper short-term drawdowns we've seen in this cycle so far. Mainstream coverage is focusing on the usual suspects, but two underreported dynamics tied to global capital flows appear to be playing a major role. First, the yen carry trade is under pressure again. The US dollar versus Japanese yen pair has climbed back above 160, right in the zone where the Bank of Japan has historically intervened or issued strong verbal warnings to defend the yen. Japan previously spent a record 11.7 trillion yen, around 73 billion US dollars, in interventions in April through May 2026 to support the currency. A renewed push higher in the US dollar versus Japanese yen pair raises the risk of further unwinding of yen-funded positions. Japanese investors and funds that borrowed cheaply in yen to buy higher-yielding foreign assets, with US stocks and bonds prominent among them, are likely selling to repatriate capital or cover as the yen strengthens or intervention looms. This kind of flow reversal has amplified volatility before. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Second, China is cracking down hard on outbound investment flows into U.S. markets. Regulators have ordered major offshore platforms, Futu, Tiger Brokers, and Longbridge, to wind down mainland Chinese access to U.S. stocks, fining them billions of yuan and giving them 2 years to close illegal accounts. New accounts and inflows are blocked. Existing positions can only be sold. This comes after massive estimated capital outflows, around $1 trillion in unauthorized flows in 2025 alone. Beijing is steering domestic savings back home and tightening capital controls, which removes a source of buying support from U.S. equities. These aren't the only factors. Rate worries, oil prices, and profit-taking after a strong rally play in too. But the combination of Japanese repositioning and large-scale Chinese de-risking and outflow restrictions represents real selling pressure that hasn't gotten the headline attention it deserves. When big global players unwind leveraged positions or redirect capital en masse, it moves markets, even if it's not the lead story on CNBC. Flint West signing off.